sink in better.
That stays in there. You're taking the opportunity to really consolidate the knowledge of these things, even though you've seen them before. Yes. That's good. That's very good. Are we starting to record yet?
We are recording right now.
Okay. Moving on with ratios. First, we're going to talk about financial leverage. Now, there are two types of leverage: financial leverage and operating leverage. Here we're going to talk about financial leverage. In a future video, we will talk about operating leverage. Anytime you see the term leverage, think risk and return. Leverage is about measuring the level of risk. The higher the leverage, the higher the risk. And every time you hear somebody say the higher the risk, you better respond with, and the return better be better too, right? Because otherwise, why the hell are you taking the risk, right? Okay. The financial leverage ratio is long-term debt to equity. Okay? Now, what this tells you is, in effect, how much of the long-term money available to the company is provided by ownership, and how much is provided by outside sources. The more provided by outside sources, the higher the risk. Why? Because guess what? Equity doesn't have to be repaid. Long-term debt, well, I've got a sneaking suspicion that the banks are going to be knocking on your door pretty darn quickly wanting their money. Okay? Debt must be repaid. Equity does not have to be repaid. Interest on debt must be paid. The only thing comparable in equity would be dividends. We'll talk about that later, but suffice it to say, dividends are in effect a kicker, a kind of sort of profit share with stockholders, with equity holders. But there is no law saying dividends must be paid or the amount that must be paid.
I think Apple got into a argument with its investors because they have a huge cash on hand and they weren't paying out a very high dividend. So everyone was like, we're investing in you, why aren't you paying out a dividend?
Well, I'll give you another fascinating example. Google has more money
Than God.
Okay, thank you. That's what I was going to say. But, and yet, they don't pay dividends. Okay? As far as they're concerned, they want to build the largest company. They want to build the most financially strong company. For all intents and purposes, they already have. But they want to have an absolute powerhouse. Dividends? We're keeping every dime in-house. Now, I can tell you that from an emotional standpoint, from a maintenance of stock price, once you have paid dividends, if you then significantly reduce or eliminate the dividends in any given year, that's a big red flag to the marketplace. Hey, we're having trouble. How important is this? I mentioned Costco. One of the things Costco actually did a couple of years ago, they didn't have a great year. But in order to pay their dividends, they borrowed, long-term debt, $4 billion. And that $4 billion came in and went poof, right out for dividends. That's how much their management believed that they had to maintain their dividend payout even though they'd had a tough year. Okay? All right. Now, I want to give you an example. Actually, we'll leave this as is for now. I want to talk about the profitability ratios. Net income to sales. Why is net income to sales a telling number? And what, in fact, does it tell you? Well, Facebook's net income to sales this year is projected to be over 25%. Okay? Last year it was 23.4%. Now, what does this mean? What this means is that for every dollar of sales, they're dropping a quarter down to the bottom line. Okay? As opposed to Amazon. Those of you who know me know that Amazon is my favorite financial whipping boy. Amazon this year was profitable. Yay! It was profitable to the tune of 0.55% net income to sales. Now that's 0.55%. So half a penny dropped to the bottom line for every dollar of sales. Sales were huge, $107 billion. But half a penny dropped down to the bottom. Okay? Facebook is dropping down 25 cents. Now, you might say, well, that's nice. I guess that tells me a lot about the company. But what does it say? Remember, all of this stuff is about management decision making, management flags. What does that tell me about what management should be focusing on? In Facebook, increase sales. I don't care how you do it. You're making a mint on every dollar you sell. Increase your sales. And believe me, they're totally focused on that. Even though Zuckerberg insists that they're not. They are. Amazon, on the other hand, slow down on the sales growth. You got $107 billion. Peachy, that's great. Now, how about if we try to figure out how to, I don't know, make money on the sales? Actually bring something down to the bottom line? Because, after all, sales are only good insofar as they reflect the bottom line or the potential for future bottom line. What are we doing in business? We're in business to make money. We're not in business to make sales. We're in business for the bottom line. Top line, that's for ego. Sit around and toast the fact that you got $100 billion in sales. Sweet. Bottom line is what it's all about. How much money did you make? Okay? So, net income to sales, flags for management, the direction that they should take, the focus they should have. Okay? Net income to equity. If you had a portfolio of $100,000 that you gave to a money manager to invest for a year, at the end of that year, what would your question to him be?
What was my return on investment?
What was my return? How much money did I get, right? This ratio, from a corporate standpoint, is what's called the ROE, return on equity, okay? This ratio tells you you had X amount of money, what kind of percentage return did you get on your money, okay? So, that's those two. How we doing on time?
9:30. So, I mean, if we're done with
Okay, let's go ahead and close this down for now.
Okay. You want me to hit stop or?
Yeah, go ahead.